Today, we're gonna go through the fascinating story of Mark Leonard, the founder of the highly successful holding company Constellation Software that is currently valued at $54 billion. We'll dive into his incredible journey and the interesting insights that led him to his success. But first, can you guess some of the unique jobs he had before finding his life's mission? Stick around to find out. You see, Mark Leonard was a very private guy. Not much is known about his early life, but we do know he attended the University of Guelph in Ontario in the early 1970s. With limited financial support, he worked all sorts of jobs to put himself through college. Can you believe he was a grave digger, park ranger, bouncer, furniture mover, windmill researcher, warehouse employee, and even a mason helper? It took Mark 7 years of hard work and part-time classes to get his bachelor degree. But guess what? He didn't stop there. Mark kept working to pursue an MBA at the University of Western Ontario's Ivey Business School. After graduation, Mark found a job as a banker. It was higher paying and secure, but he realized it wasn't for him. A superior even told him that he wouldn't want to be a banker for long. So Mark went through the bank's client list to find something more interesting. That's when he discovered his passion for venture capital. Mark applied to every Canadian VC firm but got rejected by all of them. Instead of giving up, he used his savings to attend VC conferences, network, and find a better opportunity. Finally, his persistence paid off, and he joined Ventures West, a leading VC firm in Canada. Over 11 years in the VC world, Mark learned what he wanted to build. He remembered the satisfaction of creating something that would last for a long time, like his masonry work. He was inspired by the teachings of Buffett and Munger and wanted to build a lasting company. Then he had an incredible insight. He noticed that the most successful investments by Venture West were vertical market software companies. These businesses had competitive moats, but were too small to make a significant impact on the portfolio. So Mark came up with a brilliant idea: create a holding company that would focus solely on acquiring VMS companies. And that's how the journey of his ambitious project, which he initially wanted to call Software Co., began. So what do you think about Mark Leonard's story so far? Can you relate to his journey of discovering his true passion? Mark's reputation for being smart, hard-working guy caught the attention of his colleagues at Ventures West. They were eager to support his idea, and with the help of an old business school friend working at Omer's pension fund, Mark raised a whopping 25 million Canadian dollars. But there was just this one thing: his colleagues thought the name Software Co. was terrible. So Mark came up with a new name: Constellation Software. The name represents a unifying picture of otherwise unconnected places, just like the stars in a constellation. And so, in 1995, Constellation Software was officially born, with its headquarters in Toronto. What do you think of the name Constellation Software? Do you feel it represents Mark's true vision? To do that, we'll have to go back to the early days. Back in the early days, Mark was the guy leading the acquisition process. You see, they had their eyes set on VMS companies. And let me tell you why. These VMS companies had software that was super important to their users, but their markets were very small. So big players stayed away. Plus, their recurring revenue and low maintenance made software really attractive. Pretty clever, right? So Constellation made their first move in 1995 when they bought Trapeze, a company that provided fixed route scheduling software to public transit authorities in North America. And guess what? Just a year later, they got Harris Computer Systems, focused on software solution for the utilities industry. Mark must have known them pretty well, as both were Venture West portfolio companies. Now, here's something interesting. Mark Leonard used to write a newsletter called Opportunity Above All. They didn't publish many editions, but there were some cool insights in there. In the first one, Mark talked about a company with high revenue growth and good EBITDA margins, and said that they'd been worth around 1.65 times its revenues before any discount for private companies. And he added, "We focus on buying companies that have a track record of double-digit growth and good profits. When we can find an industry-leading firm with these characteristics and good management, we'll pay up to 1.25 times revenues in cash. To the extent that these characteristics are missing, we discount the price." That's what he said. So what do you think about constellations, and Mark's approach to acquisitions. Do you think it's a smart move to focus on smaller markets with high growth potential? Now, remember that newsletter I mentioned called Opportunity Above All? Let me tell you more about this. It usually discussed valuations and why VMS owners would choose to sell to Constellation Software. Now, you might think that paying a 1.25 multiple of revenues for a software company with positive cash flow seems too cheap. But you should know that these companies usually had revenues below $5 million and were limited in their growth prospects because of their small markets. Plus, private equity firms often only focused on larger companies. But it's worth noting that valuations have gone quite up since 1998. One of the key reasons for Constellation's success was having multiple capital allocators who could find acquisition opportunities and deploy capital themselves. This was super important because they were buying lots of small companies. A few years down the road, something interesting happened. Mark's friend, who had helped set up the original investment, left the pension fund. A new analyst came in to oversee the Constellation investment, and well, let's just say they didn't get along as well as Mark and his friend. This less than friendly relationship pushed Constellation to bring in another big shareholder to balance out the pensions fund influence. So they got TD Capital, Canadian private equity partners, on board with a $60 million private placement. And guess what? That's what led to their IPO in 2006 on the Toronto Stock Exchange under symbol CSU. But here's the twist. Their IPO didn't raise any primary capital, means any money that Constellation would receive. Instead, it was all about giving early investors like TD Capital a chance to cash out. In fact, Constellation never raised public equity capital, and their shares outstanding have stayed the same at around 21.2 million. Back at the time of the IPO, they had already acquired 45 companies with total revenues of 165 million and a global presence across 40 offices. Not too bad, eh? Now, hear this. Fast forward to today, Constellation brings in over 5 billion in annual revenue from more than 750 separate companies. Their market cap skyrocketed from around 275 million at the IPO to about 32 billion, making it a 120 bagger over 16 years, with an annual total shareholder return of about 35%. Impressive, right? So now that you know a bit more about their journey, let's dive into the details of their business. You ever wonder how some big companies manage to pull all the strings without getting too involved in the nitty-gritty? Well, let me tell you about how Constellation Software is doing just that. It's not your everyday business. It's a holding company that controls 6 VMS-focused operating groups. Sounds complicated, right? But hold on, I'll break it down for you. Picture this. Constellation Software is like a big umbrella, and under it are 6 operating groups that specialize in different software verticals. Each one of these groups has its own little world of business units. Back in the day, these groups were just small VMS companies, but they've grown into something much bigger through loads of acquisitions. Now, Mark Leonard, who came up with this idea, was inspired, as we mentioned before, by the Ventures West portfolio companies. And guess what? He decided to stick with the same hands-off approach for Constellation as well. So these operating groups, they've got tons of freedom to run things their way. Pretty cool, right? But why all the autonomy, you ask? Well, Constellation believes that it's the key to attracting and keeping the best talent around, especially the big shots running those operating groups. I mean, who wouldn't want to be their own boss, right? Plus, with so many business units within each group, it's crucial to let decisions be made at a more local level. After all, some of these businesses might be just a tiny piece of the whole Constellation pie. So what do you think about this unique setup? Can you imagine a world where more companies give their teams the freedom to make their own decisions and call the shots themselves? Now, if you ever look at the logos of Constellation Softwares, there are 6 operating groups that you'll find, and you'll find something very interesting in there. Well, TSS, for Total Specific Solutions to start with, they got merged into Topicos. But that's not the whole story. You see, Constellation used to separate their customers into public and private end markets. And for good reasons. Their spending habits were pretty different. But let's rewind a bit. Volaris, Harris, and TSS fell under the public sector category, while Jonas, Perseus, and Vela were in the private sector group. But then something interesting happened. Around 2013, Mark Leonard noticed that the lines between public and private sectors were getting blurry. For example, Trapeze, which is a business unit in Volaris, started dipping its toes into the private sector world. Even so, Constellation kept using the public-private distinction in their reports until 2020. That's when they realized it was more important to focus on meeting their capital deployment goals rather than just serving specific markets. So they decided to ditch the two reporting segments and go for a single one. But get this, 35% of the public sector revenues were actually coming from commercial clients, and 15% of the private sector revenues were tied to government customers. If you do the math, it's almost 50-50 split between public and private sector customers by revenue. Nowadays, even though they've combined the private and public reporting segments, Constellation still breaks down their revenues into 4 segments. What do you think about this shift in perspective? How important would you say is it for companies to adapt to changing market dynamics? To understand that, let's dive into Constellation's 4 revenue segments and how they make their money. These segments are 1. Licenses, 2. Professional services, 3. Hardware, and 4. Maintenance and other recurring revenue. They report these revenues across all 6 operating groups, including Topicus, in which they have a 1/3 interest. Now, the biggest chunk of the revenue pie is maintenance, which accounting for over 70%. Keep in mind that these segments aren't separate entities. Businesses often have multiple income streams for their clients. For example, a company might charge for a software license, then collect annual maintenance fees, and additional revenue for customization or local setup help. And here's the breakdown of each segment for Constellation. Licenses, fees charged for using the software, typically under multi-year or perpetual agreements. Maintenance and other recurring, those are fees for post-delivery customer support, including recurring SaaS fees, combined software, support contracts, and hosted products. Customers get product updates when and if available. We then have professional services. Those are fees. We have their fees for implementation, integration, customization, product training, and consulting. Hardware and other. This is revenue coming from reselling third-party hardware or selling custom hardware assembled for customers. They report this line net of third-party hardware costs to minimize top-line distortion. Now let's look at some of the numbers from 2016 to 2021. Licenses revenue grew from 143 million in 2016 to 287 million in 2021, accounting for 6% of total revenue. Professional services revenue increased from 434 million to more than $1 billion, making up 20% of total revenue. Hardware and other revenue hovered around 150 to 176 million, representing 3 to 7% of total revenue. Maintenance and other recurring revenue rose from $1.4 billion to 3.6 billion, which is 60 to 71% of total revenue. Total net revenue jumped from 2.1 billion in 2016 to 5 billion in 2021, a bit over 5. So there you have it, Constellation's revenue segment and their growth over the years. Which segments do you think has the most potential for growth? And how can Constellation leverage these diverse income streams for future success? And I know you might find it strange that licensing is about the right to use the software without actually owning it. But when you consider the history of the software industry and the development of ERP systems, it starts to make more sense. ERP, which stands for Enterprise Resource Planning Systems, by the way, are information systems that integrate data within and across different functional areas of our organization, like accounting, HR, manufacturing, and more. Before the internet and powerful computers, large businesses needed their own servers to run ERP systems. These servers were on premises for easy access and speed, but that also meant limited accessibility for third-party software providers or hardware technicians. To install software, providers had to physically enter the company's on-prem facilities and use disks. Once the software was on a server though, the original provider couldn't monitor or disable it. That's where licensing come in. Since software companies couldn't technically control their product once it left their hands, they used licensing to do so contractually. For many years, it was standard practice to charge for a license to use the software, with separate fees for the software itself. However, this model began to change with the shift to SaaS, software as a service models. With SaaS, servers are now off-premises, of course, and software is distributed with the internet. This change made it possible to reconnect to the right to use the software with the actual possession of it, something that was impossible when software were distributed on disk. This new model put control back into the hands of the software providers, who could now technically turn off the software if it misused. While software misuse by corporation wasn't too common, and there are still terms of service agreements with SaaS providers, this historical context help us better understand the industry. Just imagine a company's server room from the 80s and you'll get a glimpse of how far we've come. How do you think the software industry will continue to evolve right now, especially when we have AI coming? What impact will new technologies and distribution methods have on licensing and software control? Now, before diving back into Constellation software, let's take a moment to compare traditional enterprise software models and SaaS. With the traditional model, software companies receive high margin, but lumpier licensing revenues from selling the rights to use the software, as well as decently profitable stream of revenues from software maintenance and updates. Maintenance revenue typically amounts to 20 to 25% of the original license cost and can be indefinitely. Additionally, software customization is another source of revenue. Although it's less profitable due to development costs, it does make customers more reliant on the product, creating a stickier customer base. The large upfront investment needed to set up the software, along with the potential disruptions and costs involved in switching providers, further contribute to customers' retention. In essence, customers rarely churn because there are no easy substitutes. Switching costs are high, and even mediocre software provides significant value. As a result, software businesses enjoy a very high LTV, right? Their lifetime value for each customer, which is reducing their need to constantly attract new clients, which is amazing for every business. So traditional software sellers benefit from lucrative licensing revenues, profitable recurring maintenance revenues, and customer-funded customization that increases product attachment. This combination leads to a high LTV for each customer, allowing software companies to focus less on acquiring new customers and more on maintaining their existing relationships with existing customers. But how do you think the shift to SaaS impacts these factors? Will software companies be able to maintain their high LTVs and customer retention in a more competitive market or not? What do you think? Because while SaaS has increased accessibility and affordability for many businesses, there are trade-offs for software providers. Let's examine the pros and cons of SaaS from the perspective of software companies. Some of the pros are there's lower friction to start using the service, right? The software is delivered via the internet, making it easier for customers to start using the service without scheduling appointments or involving their IT departments. Larger customer pool, the lower upfront commitments and monthly billing cycles make software more accessible to a wider range of customers. Some of the cons are less committed customers, because as the barriers to entry are lower, customers may be less committed and more likely to switch providers, which means higher customer churn, right? With lower switching costs, customers are just more likely to switch providers, leading to higher churn rates. Increased competition. The introduction of public cloud platforms like AWS, for example, or Azure and GCP has lowered the barrier to entry for new software providers and increasing competitive intensity. Worse working capital dynamics, right? Monthly billing cycles compared to traditional upfront annual payments result in less attractive cash flow for software companies. So while SaaS has expanded the market for software and made it more accessible to a larger number of businesses, it has also introduced challenges for software providers. Higher competition, lower customer loyalty, and worse working capital dynamics have led industry veterans like Mark Leonard to approach the SaaS model with caution. Moreover, the high valuations of SaaS companies have sometimes encouraged wasteful competition and growth, as market dynamics incentivize short-term gains at the expense of long-term profitability. So by focusing on vertical market software, Constellation is able to cater to niche markets with unique software requirements, and there are several advantages to this approach, like limited competition, right? Since the markets they target are inherently limited, there are fewer competitors targeting the same customer base. This allows Constellation to establish a strong foothold in these markets. Highly specialized solutions, right? By providing highly specialized software solutions, Constellation can create a strong value proposition for their customers. And this can lead to better customer satisfaction and loyalty. What about lower impact of SaaS disruption? The niche markets that Constellation focuses on are often less impacted by disruption caused by SaaS. This is because the specific needs of these markets may not be met as well by generic SaaS solutions, allowing Constellation's traditional enterprise software model to continue thriving. What about stickiness? The specialized nature of the software make it more difficult for customers to switch providers, right? This creates stickiness, as the cost of switching providers, including the time and resources required to re-implementation and customization, can be quite high. What about stable revenue streams? By catering to niche markets with unique requirements, Constellation can secure stable revenue streams from its customers. This is particularly true for maintenance and support services, as customers rely on Constellation's expertise to keep their systems running. So in conclusion, Constellation's focus on vertical market software, which allows them to cater to niche markets with unique software requirements. This approach insulates them from some of the challenges associated with the SaaS model, while offering several advantages, such as limited competition, highly specialized solutions, and stable revenue streams. By serving customers in niche markets with the software model best suited to their needs, Constellation can maintain its position as a leader in the vertical software space. Which is why Constellation approach of acquiring businesses that run both the traditional enterprise model and the SaaS model, as well as transitioning businesses where it makes sense, has allowed them to maintain a unique competitive position in the market. Their focus on niche industries has provided some insulation from industry-wide pressures brought on by the rise of SaaS. And remember, the company's hundreds of vertical market software, right, the VMS businesses together generated over $5 billion in revenue in 2021, approximately $5.7 billion in the last 12 months, with maintenance revenue accounting for more than 70% of that total. Constellation Software's average EBITDA margin is around 25%, translating to just under 20% free cash flow margin. In 2021, the company generated $1.4 billion in EBITDA and around $900 million in free cash flow. Their acquisitions for 2021 totaled approximately $1.2 billion, with $1.7 billion in the last 12 months. By strategically acquiring and managing a diverse portfolio of VMS businesses, Constellation Software continues to adapt to the changing landscape of the software industry. Their focus on niche markets and flexibility in using both the traditional enterprise model and the SaaS model allows them to maintain a strong competitive position and generate significant revenue and profits. As the software industry continues to evolve, Constellation Software's ability to adapt and serve its customer in the most effective way possible will be crucial to their ongoing success, which lead me to their moats. What is the competitive advantages that CMI got? Well, the competitive advantages enjoyed by VMS companies like Constellation Software can be summarized as follows. Mission critical, right? The ERP solutions provided by CSI's businesses are essential for the smooth functioning of their customers' operations. Once adopted, these software solutions cannot be removed without suitable replacements. There are few substitutions. There are few substitutes. In each vertical market, there are typically only a couple of options available, and CSI's businesses are usually the number one or number two provider in their respective markets. There's a small, fully served TAMs, right? The small total addressable markets, the TAMs, protect incumbent players from new entrants. Early movers can establish a sustainable advantage by serving the entire market before another player can enter. especially when customers are captive and it's difficult to convince to switch. What about switching costs, right? High switching costs make it difficult for customers to change providers. Switching ERP software can lead to disruption in business operations, to customer churn, to lost sales, integration issues with other software, and the need for retaining employees. A competitor's product would need to be significantly better than the existing solution to justify the costs and risk of switching. Also, small portion of total cost, right? The cost of the software relative to the customer's total cost base is usually very small, usually less than 1%. So given the importance and stickiness of the software, competitors are unlikely to succeed by competing on price alone. The combination of these factors create a strong competitive advantage for VMS companies like Constellation Software. Their focus on niche markets with limited competition and high barriers to entry allow them to maintain a very strong position in the industry and generate significant revenues and profits, of course. For a new entrant to successfully displace an existing VMS business, they would need to overcome several significant challenges. They'll need to offer a considerably superior solution, right? The new entrant software must be demonstrably better than the existing solution, so convincing customers that it is worth the risk and investment to switch. They'll need to address risks and disruptions, right? Customers must be convinced that the potential benefits of the new software outweigh the risk of disrupting their operations and alienating their clients potentially and potentially losing sales during that transition. I'm not even talking about integration and employee training, right? The new entrant, they'll must ensure seamless integration with other software systems and provide educate training to the customer's employees who may have used the existing solution for decades. It's not easy to change that. Customization. If the incumbent VMS company has created custom features for their customers, the new entrants must prove that they can recreate those features quickly and effectively. And this can be challenging, as the incumbents developers likely have a deep understanding of the customer's requirements and invested significant time and effort in creating customized solutions. The new entrant must also be prepared for the possibility that the incumbent VMS company could simply match their offering, right? Making it 10 times more difficult to convince customers to switch. So given these challenges, it is unlikely that a new entrant can easily displace an established VMS company unless the incumbent has consistently underperformed and failed to meet customer needs over an extended period. The barriers to entry and competitive advantages enjoyed by VMS companies like Constellation Software make it very difficult for new players to penetrate their niche markets and steal market share. And that's before talking about their other business virtues, right? Like the idea that the competitive advantages of Constellation Software as a holding company and buyer of other VMS businesses are distinct from the advantages enjoyed by VMS businesses themselves. Because while the VMS businesses have strong competitive positions due to their niche markets and their mission-critical software, high switching costs, and other factors, Constellation's advantages lie in its unique approach to acquiring and managing these businesses. Some of the key advantages of Constellation Software as a holding company include things like expertise in acquiring and integrating VMS businesses, right? Think about it. Constellation has a very strong track record of successfully identifying, acquiring, and integrating VMS businesses into their portfolio. This expertise helps the company to efficiently expand its market presence and capitalize on synergies between their different businesses. They have also a decentralized management structure. So Constellation Software follows a decentralized management approach, empowering the individual VMS businesses to operate independently and also make their own decisions. This allows for greater flexibility and adaptability, ensuring that the businesses can respond quickly to changing market conditions and customer needs. They have access to capital and resources, right? As a holding company, Constellation can provide their VMS businesses with all the necessary capital and resources to invest in growth and any innovation ideas they have. This helps the businesses to stay competitive and better serve their customers. Next is cross-selling opportunities, right? With the diverse portfolio of VMS businesses, Constellation can leverage cross-selling opportunities by offering different complementary products and services to its customers. So this is not only strengthens customers' relationships, but also drives additional revenue growth. Next is their reputation and credibility. Constellation Software's reputation as a successful holding company and its experience in managing VMS businesses can help attract potential acquisition targets moving forward and foster trust among customers and partners. But it's also essential to note that these advantages are not as intrinsic as those of the VMS businesses themselves. They are subject to factors such as management effectiveness, their acquisition strategy, and of course, market dynamics. Therefore, Constellation's competitive position as a holding company requires continuous nurturing and adoption to maintain their edge in the market. Which lead me to discuss about their holdco philosophy. The decentralized structure of Constellation Software provides several advantages. Things like autonomy and independence, right? By allowing individual operating groups and businesses to function autonomously, Constellation Software creates an environment where talented employees and operators can really make decisions independently without being bogged down by bureaucracy. This helps attract and retain skilled individuals who value their freedom to innovate, manage their businesses effectively, and many more things that they have in mind. There's also the attractiveness here to entrepreneurs, right? Think about it, the level of autonomy provided by Constellation Software is particularly appealing to entrepreneurs who seek to have a liquidity event while still retaining in control over their business. Or there are those who care about providing a permanent home for their businesses without the risk of layoffs and letting go of their people. This makes Constellation Software a preferred choice for many owner-operators that are looking to sell their companies. Next is scalability. The decentralized structure enables Constellation Software to manage a large number of companies efficiently. With more than 750 companies under their umbrella, centralization would slow down the decision-making process and actually hinder innovation. Decentralization allows for a quicker response to market changes and different customer needs. And it's ensuring that the businesses remain agile and competitive. It's also the flexibility. Think about it, decentralization allows each operating group to adapt their strategies and operations to the specific needs and challenges of its respective verticals. That flexibility empowers the businesses to respond effectively to market dynamics, to the competition, to different customer requirements. There's also cross-pollination of ideas, right? Because while each operating group and business functions, they function autonomously basically, the broader Constellation Software network enables the sharing of best practices, of best ideas and insights across their various businesses. And this cross-pollination can lead to innovative solutions and improvements that benefit the entire company. So Constellation Software decentralized approach enables to effectively manage their vast portfolio of businesses while fostering a culture of autonomy, innovation, and adaptability. And this structure has been key to its success in acquiring, integrating, and growing a diverse array of vertical market software businesses. Next, let's talk about how Mark Leonard sees culture and the way it impacts his company. You see, Mark Leonard is not your typical CEO. He's not a big fan of top-down culture, the kind that forces people to conform to specific values across the entire company. He believes it's kind of authoritarian, especially when you're dealing with thousands of employees worldwide. He even admits that the most employees at the portfolio companies probably don't know who he is, and that's totally fine with him. Why? Because the culture that really matters to Leonard is the one that each individual business units create, no matter how different they are globally. What's important is the loyalty employees have to each other and their small unit. Funny enough, it's his dislike for top-down culture that probably helps preserve the unique cultures at the business unit level. When a company gets acquired, usually not much changes in terms of their day-to-day operations. Now, don't get me wrong. There is a strong culture of sharing best practices across different units and operating groups. And guess what? To support this practice, employees, depending on their authority, are required to invest up to 75% of their cash bonuses in Constellation stock. You might ask, why do they do that? Well, it's believed that this forced purchase of stock creates better employees buying because they're using their hard-earned cash to buy shares, rather than just getting them as an added perk. And let me tell you, this practice has been going on since early years of Constellation. In 2015, Leonard mentioned that they've created over 100 employee millionaires. And that number must be even much higher now since the stock has gone up 5x since then. And here's the cool part. This level of employee buy-in is matched by the company itself. They also prefer to overall promote internal candidates, with 84% of business unit leaders being promoted from within in 2016. This means that even the operators who sold their companies to Constellation have a chance for career growth. So what do you think about this super unique approach to culture? Can you imagine working with a company like Constellation Software? Next, let me tell you about the interesting mix of people working at Constellation Software. You see, they have business operators and entrepreneurs who are also responsible for capital allocation. This unique combination leads to better investors and businessmen working together. Each business unit has a clear metrics that they need to hit, with ROIC, return on invested capital, and organic growth. And Mark is using those two things as the most important ones, because by focusing on these factors, Constellation can avoid turning into some kind of a political bureaucracy and instead keep their focus on what matters. And what matters most to shareholders is the most important in the company. And guess what? This environment allows managers to openly learn from their mistakes. They often hold post-acquisition reviews to discuss what went well and what didn't. And this helps them grow and improve. Thanks to these clear metrics, managers and employees can move more cohesively across business units as they have a common ground for their day-to-day decisions. So even though Mark Leonard might not be a fan of top-down culture, an interesting culture has developed at Constellation. Some would say their culture can be described as trust-enabled decentralization, born from broadly pursued competence and a strong system of aligned incentives with feedback loops. There is, however, one aspect that is not left to the managers to decide, which is what is considered acceptable capital allocation. In the next part of our story, we will see how the limits of their structure and strong culture can be both a competitive advantage and a challenge. Now, I'm curious to know, what do you think about this unique way of doing business? Can you see any potential challenges or benefits of having a trust-enabled decentralized culture like Constellation? So let's discuss their capital allocation process. So far, we talked a lot about the vertical market software businesses, the VMS businesses. But let's not forget that Constellation Software's main focus is capital allocation, not selling software. They invest in VMS because they feel confident that it meets their high standards, thanks to the competitive dynamics and the support systems that they've built over the years to run VMS software companies. Coupled with a large database on VMS acquisitions, they make sure they consistently meet their ROIC targets when deploying capital. They stick to their circle of competence, knowing what they can and can't know, which helps mitigate risk when allocating capital. When Constellation first started, Mark Leonard realized that the main challenge was deploying enough capital into VMS. To address this, they aim to compensate for the small capital size of each transaction by doing many transactions in the beginning. The headquarters, they could handle acquisitions, but as they grew, they delegated capital allocation responsibilities to each operating group. In the early days, people in an operating group could recommend an acquisition, but they didn't have the power to see it through. Acquisitions above 2 million back then needed board approval. Today, the limit has increased to over 20 million. Even back then, Constellation was laying the groundwork for business unit managers to take responsibility for capital allocation, which encouraged them to think like investors. And that's a skill that is often lacking in business managers. Can you see the benefits of decentralizing decision-making and empowering business unit managers? Look, back in 1995, Constellation Software made their first acquisition, Trapeze, right, which also became their first operating group. This acquisition set the stage for their strategy moving forward, expanding not only in public transit, but also into 5 other verticals. Whenever Constellation enter a new vertical, they make what we call a platform acquisition. Their first acquisition in that specific sector, in that specific industry, which basically means that it gives them a foothold to then continue growing. And from there, they can go out there and make further what we call tacking acquisitions related to the vertical. The reasoning behind this approach is that the managers of the operating groups like Trapeze are in a better position than the headquarters to learn about those different companies in their industry. So by involving them in the acquisition process, it greatly increases coverage of different potential acquisitions and leverage their expertise. Constellation Software's advantages in acquiring VMS businesses may not be as strong as the VMS businesses themselves. As Mark Leonard once said, the barriers to enter this business are basically just a telephone and a checkbook. However, Constellation has built up some super good competitive edges over time. And some of them, like we discussed, include their reputation for decentralization, allowing management to run the company without interference. Also, things like a quick and minimally disruptive acquisition process, right? And things like assurances that employees won't be laid off. There are also those different accommodating deal structures. For tax, there's also accommodating deal structures and earnouts, right? So they're paying cash with no long-term restrictions. They've never funded an acquisition with equity, just to give you an idea. They also guarantee that the acquired company will remain intact for the long term and not be continually flipped like happens with private equity firms. There's also the potential for Constellation to help support further growth. And these factors are particularly popular with owner-operators, right, who make up an estimated of 70 to 80% of Constellation acquisitions. Another estimated 10 to 20% of acquisitions came from corporate carve-outs. What do you think about those advantages? Do you think there are other advantages here when it comes to acquisitions in the VMS space? Can you see how these factors might make them an attractive choice for potential acquisition targets? Because think about it, for owners of small VMS companies, finding a suitable buyer can be quite challenging. Full liquidity events are super rare, as most companies never reach a scale where an IPO is feasible or makes sense. And even if they do, owners often hold most of their shares to avoid depressing the price and demotivating employees. Corporate M&A usually involves conditions to keep current management in place, with equity vesting things over several years to what we call align incentives, right? There's also selling to private equity that might be the best option for an owner operator, but if they want to cash out, but most VMS companies are too small to attract interest from private equity firms. And even if they're big enough, owners have to be okay with the possibility of their baby being basically dismantled and employees laid off when they're selling to private equity firms. So for a long time, Constellation Software was the go-to buyer for such companies, allowing them to make early acquisitions at just 1.25x revenues. But at the same time, their success had led to the emergence of copycat software aggregators, right? To use Mark Leonard's letters as their business plan, basically. And that's why, as a result, Constellation actually became more reserved. And Leonard stopped writing his annual letters altogether in 2017, knowing that he was basically just fueling the competition. Today, Constellation often loses acquisitions to higher bidders due to their strict hurdle rate discipline and aversion to excessive leverage. Competition mainly comes from other investment funds, and they're willing to accept lower hurdle rates. They're willing to use leverage or have more optimistic assumptions. For example, in 2016, Redney Solutions initially accepted Constellation's acquisition offer, but then ESW Capital swapped in with a higher bid. Right? Then you also have newer software roll-ups like Valsoft also pose a competition as they try to pretty much mimic Constellation's playbook. You also see established software companies such as Tyler Technologies and Enchoice also compete by merging different acquired companies' products into their existing platform. And unlike competitors, Constellation doesn't factor in synergies or potential cross-selling opportunities into their purchase price. They're very disciplined. And this is partly due to their emphasis on decentralization and the belief that factoring synergies can be risky. However, some sources suggest that they may consider cost reductions from common accounting functions or HR in certain acquisitions. The Volaris group, on the other hand, for example, they seems to assume cost synergies more often, as seen in their guide to selling your software company. This could either be a newer development for Constellation or an example of how each operating group has the autonomy to make decisions for sub 20 million acquisitions. Synergies could be an advantage for Constellation if they remain conservative. What do you think? Do you think their conservative assumptions give them an edge or hinder their growth? So for now, let's talk about why and how Constellation is still way ahead of their competition. And there are two big reasons for that. First one is their acquisition database. And the second one is their coverage list of more than 50,000 companies. Now, Constellation has completed over 750 acquisitions. So they know a thing or two about making great deals. They can tell when assumptions are too optimistic or cautious and understand the unique challenges of different industries. Pretty cool, right? At the same time, they've got a list of potential acquisitions that's over 50,000 companies strong. But get this, as of 2020, they weren't even aware of 70% of the companies that were sold that year. So just imagine what could happen if they improve their coverage. They could double their chance to bid on companies. And you might be wondering, with all these acquisitions, is there room for growth? The answer is absolutely yes, because it's estimated that Constellation acquires fewer than 3% of all software companies sold each year. So even though they're spending around $1 billion on acquisitions for about 100 companies, there's still plenty of room to grow. And you know what's interesting? There's some friendly competition among their operating groups for acquisition, but it's mostly limited since their core verticals only moderately overlap. They have this first deep rule where anyone who basically identifies a company first gets 6 months to close a deal before it's up for grabs again. I think some internal competition is actually a good thing. Next, let's move to talk and take a moment to think about the future. It may not be as bright as the past, not only because increased competition, but also because Constellation's cash flow keeps growing. That means they need to keep spending more on acquisitions. What do you think will happen? Will they be able to keep up this pace? Because so far, that's why Constellation Software stands out from the crowd. Another fascinating aspect of Constellation Software's strategy is they have a category called product initiatives, which they started separating from their regular R&D and S&M spending back in 2004. But why did they do that? Well, the idea was to get a better understanding of the best use of capital by tracking the returns on their initiatives. Now, most of these initiatives take 5 to 7 years to reach cash flow break even. So they wanted to separate them from other maintenance expenses. Mark Leonard realized something that most investors would only catch on too much later, right? Software companies mainly invest through their P&L instead of their cash flow statement. Now, what does that mean? It means that growth initiatives get mixed up with other maintenance expenses, which can make it hard to see the true economics of the underlying business. Plus, since software companies usually receive cash upfront for services that are delivered later, investing cash flows in growth initiatives can look like loss basically because these investments are fully expensed in the period and their return is then delayed. Now, when you compare this to capital expenditures, which have limited P&L impact due to depreciation or amortization, it becomes even trickier to know if these P&L investments are actually creating value or if the capital could be better spent elsewhere. Constellation has been trying to answer this question through several internal studies. And remember how they started tracking their product initiatives separately? Well, just a year after they began doing that, both initiatives as a percentage of R&D plus S&M and total R&D plus S&M as a percentage of net revenue reached their peak. It seems that simply tracking their initiative spending led to better control of their expense, kind of like an observer effect. After analyzing the data, they found out that the internal rate of return, their IRR, right, on internal initiatives, generally just couldn't match the returns that they got from acquisitions. So as a result, they kept allocating less capital to initiatives, right? Business managers at Constellation essentially have three options right now for their excess capital. Number one, make an acquisition. Number two, launch an internal growth initiative. Or number three, send the capital back to headquarters. Some operating units, incentivized by a return on invested capital, they figured out that deploying smaller amounts of capital led to actually higher returns. So they used whatever capital they could without compromising returns and sent the rest back to HQ. HQ then experimented with what we call a keep your capital program for Vela and Volaris, resulting in more capital being deployed at attractive but slightly lower rates of return with higher organic growth for the business. So it seems that internal initiatives act as a buffer to absorb capital, and if they run low on attractive M&A opportunities, they can basically direct more capital into internal initiatives at good but relatively lower returns. So while HQ can occasionally kickstart the M&A process, it's mostly up to the operating groups. So this leaves HQ with two options, with two decisions basically. Number one, buy back stock, or number two, pay a dividend. Now, although stock buybacks seem unlikely since Mark Leonard has expressed this interest in that, he did mention that some executives disagree. So while they haven't bought back stock before, that policy could change in the future. To understand the rationale behind that, I'll need to tell you a story about their journey with dividends. So back in 2002, when Constellation was a private company, they started paying a small dividend, but it was just a small bit of their cash flow. Fast forward to 2012, some of their PE owners were struggling to sell their stake in Constellation. So what they did is they decided to raise the dividend to $1 per quarter. Why? Well, they wanted to make their stock more attractive to potential buyers. This move bumped up the dividend yield to about 3-4% at the time. But it wasn't really about smart capital allocation. It was more of a marketing strategy for the company. And guess what happened next? The stock's value began to rise, and those PE owners were finally able to go out there and sell their shares. Mark, the CEO, he felt loyal to the shareholders who had helped save Constellation from being sold, basically, so he didn't get rid of the dividend, even though he warned he could. Now, let's jump to today. That $1 per quarter dividend has become almost insignificant, with a yield of just around 0.25%. But in 2019, Constellation realized they were sitting on too much cash, around $850 million. So they decided to pay a $20 per share special dividend, totaling around $420 million. While this only represented about 2.5% of the stock price at the time, it raised some eyebrows. You see, a lot of Constellation's value come from being able to find high ROIC opportunities to invest in. So paying dividends or buying back shares could mean they're running out of opportunities, right? Well, luckily in the last couple of years, their acquisitions have exceeded their free cash flow. It's a good sign that Constellation still has a strong and long runway to find and invest in those high ROIC opportunities. What do you think about Constellation's dividend strategy? Do you believe they still have plenty of opportunities for growth? To understand that, let's discuss the hurdle rates and return on invested capital, right? The ROIC. And that's pretty much a summary of Constellation investment strategy. Constellation got this internal hurdle rate for all their investments. Now, although they've never shared the exact number in public, back in 2011, Leonard mentioned that they aim for 20% plus return on incremental capital. And they've actually done even better than that historically. The majority of their capital goes into acquisition. So it's crucial that they're conservative with their projection and disciplined buyers in order to maintain that high ROIC. And the way they do that is then when they evaluate in an acquisition, they create 4 scenarios, right? 4 scenarios in probability weight. They weight them to calculate cash flows. Then they determine the maximum purchase price that they'll still let them meet their return hurdle rate. And they never tweak it to go higher. They're super disciplined when it comes to their hurdle rates. Now, thanks to their data from past transactions, they can confidently make these assumptions without going overboard. So their disciplined approach to acquisitions has led to consistently strong ROIC over time. And there's something really interesting here about Mark Leonard's calculations. He adjusts net income by adding back intangible asset amortization. He believes that the economic value of these intangible assets, mostly from acquisitions, doesn't meaningfully deteriorate in a given period. Moreover, Leonard claims that they're appreciating intangible assets more than offset any depreciation. Now, while no one can directly confirm this, we do see that maintenance revenue from new customers and price increase offset the annual churn of around 7%. So this suggests that there's no significant impairment. Now in 2018, Leonard switched to a new metric called free cash flow available to shareholders, or free cash flow A2S, believing it's better to start with an IFRS metric and reduce it, rather than starting with net income and adding to it. Now look, everyone is usually skeptical about management adjusted figures, but Leonard's calculations seem to be fair representation of owners' earnings. Next, let's dive into the Topicus situation and how it affects Constellation's calculations essentially. So Constellation has an obligation to buy a portion of Topicus at a price determined by the IRGA. Next, let's expand a bit more about the relationship between growth and ROIC, return on invested. Next, let's expand a bit more about the relationship between growth and ROIC, the return on invested capital, in software companies like Constellation. So as Constellation focuses on growing, their ROIC sometimes takes a hit. Why? Well, remember when we talked about how software companies invest in growth initiatives using their R&D and S&M budgets? That's right. So these investments can lead to short-term drops in ROIC because there is increased expenses. Now, the brilliant Mark Leonard, he looks at both ROIC and organic growth. So what he's doing is he uses a concept called basically ROIC plus organic growth, which is similar to kind of like the rule of 40 popular among other software investors, which basically said that margin plus revenue growth should be above 40. Now for Constellation, M&A has been the primary focus over organic growth, right? Mainly because, like we said, it takes 5 to 7 years for growth initiatives to pay off. But Leonard encourages long-term investment by including organic growth in the equation. And Leonard actually would rather have another point of organic growth than of EBITDA margin. That implies that ROIC could be even higher if we took out all those growth initiatives across the company. So let's discuss some of those different segments in Constellation's organic growth. We've got hardware and other licenses, professional services and maintenance revenues. And the drop, for example, in hardware and other isn't a big deal, and it's because it's just a small portion of the revenue. Licenses have been lackluster, but they're only about 6% of the revenue. What about professional services though? They make up about 20% of revenues, but their impact goes beyond just money. These services involve software customization and require lots of one-on-one time with clients. And this makes the relationship with customers much stickier and differentiate Constellation from off-the-shelf softwares. Pretty cool, right? Then there's also maintenance revenue. So Constellation sees this as the best measure of business health and pretty much the most important revenue stream due to their recurring nature. Over time, maintenance revenue have grown and become a more significant part of the revenue pie. Since 2016, total organic growth have averaged 2%, but maintenance revenue is around 4%. Now, it might not seem impressive compared to other software companies, but remember, it's the IRR, the internal rate of return that matters, not the growth rate. Now look, with Constellation, it's not just about growth, but it's their ability to deploy incremental capital at a high ROIC. But is Constellation like a cliche private equity firm, buying dying assets and bringing them for cash? Let's explore that idea together. Because some critics might argue that Constellation's 7% organic growth is the result of massive price increases on recent acquisitions, hiding shrinkage in the rest of their businesses. But that approach would be risky because it will require more and more companies to maintain its size due to the short lifetime of the assets. And this means that they have to acquire even more companies every year and raise prices even higher just to maintain their earnings. So the concern here isn't just whether Constellation can grow, but it's if their terminal value is too high, which creates more impaired businesses. Some would say this criticism is valid, some would say that it's not. Let's look at the numbers to find out. If you see the 2015 letter from Mark Leonard, he breaks down the components of maintenance revenues because he wanted to show the composition of organic growth. So while it's true that 7% or so churn is a bit on the higher end for a software company, we can see that new maintenance growth usually meets or exceeds total attrition. Price increases do contribute to growth, but they're not necessarily to offset customer churn. So this suggests that in aggregate, Constellation VMS companies aren't becoming impaired, but they are actually becoming a little more valuable each year. So it seems that Constellation's main approach isn't just wringing in cash from dying assets, but actually growing their portfolio value over time. So growth is constantly important for Constellation, and they're exploring new ways to achieve it. One example is their recent Topicus transaction, which aimed to learn how Topicus drives high growth organic growth. So acquiring this skill could relieve some pressure on the M&A teams, right, to constantly deploy increasing amounts of capital. Another initiative of theirs is the VMS Ventures, which aims to fund internal startups. Because sometimes good ideas are left behind or taken by departing employees because business units just can't assure an acceptable ROIC. So now with 200 million in VMS Ventures, these ideas can now be funded internally without risking the business unit's results. So the goal is to encourage more risk-taking and hopefully generate higher value, accretive growth for CSI shareholders. It's pretty cool. It's like an entrepreneur-style risk-reward systems for employees who want funding and want to start their own ventures. Pretty cool, right? Now look, the future of Constellation hurdle rates is uncertain, but it's clear that reproducing their past returns will be challenging. There has been some debate over their capital allocation policy, which sets a hurdle rate much higher than what individual investors can expect, at least somewhere else. But Mark Leonard defends keeping the rates high, as he believes that hurdle rates are magnetic, and lowering them could lead to diminished returns on every acquisition. As a compromise, Leonard decided to lower the hurdle rate only on large VMS acquisitions, while keeping them the same on smaller ones. This way, they can maintain the ROIC for most investments and only drop it for incremental capital. A year after announcing this decision in his 2021 letter, Constellation made a $700 million purchase from healthcare provider Allscripts, over 100 times the size of their average small VMS acquisition. And remember, Constellation is generally the avoided debt, believing that long-term assets should be funded with long-term financing. However, in recent years, they've taken on a modest amount of debt. At the end of 2019, they've had about 500 million in debt with 0.5x debt to equity ratio and a coverage ratio over 20x. Today, that's 1.8 billion or just over 1.1x debt to equity ratio with a coverage ratio over 15x. By any measure, it's a still conservative amount of debt, and half of it isn't even a recourse to Constellation. So it seems that we can expect Constellation to use more leverage to help meet their ROIC thresholds, as long as it remains modest and the covenants are well thought out. Looking at their acquisition spend relative to free cash flow, we see that since 2020, acquisitions have exceeded 100% of free cash flow. This could be a result of catching up after COVID slowed down their typical cadence. Now with larger acquisitions like Allscripts, perhaps they can run near or above 100% of free cash flow deployed on acquisitions. So I think that's a pretty encouraging trend that they're going through right now. In addition to lower hurdle rates on large acquisitions and potentially more leverage, Constellation is also open to exploring opportunities outside of their core VMS focus now. Leonard even disclosed that they were considering a $1 billion deal for oil assets before oil price surged again. They could also look into more spin-off transactions like TSS and Topicus. What do you think about this Constellation evolving approach to growth, debt, and diversification? Do these strategies make sense, or should they stick to their traditional methods? Now look, when you look at a company like Constellation, it's essential to evaluate various assumptions and scenarios to make an informed decision. Right? For Constellation, a reverse DCF, discounted cash flow, can be used to synthesize for ROIC and percentage of cash flow, at least free cash flow deployed. The company has a $32 billion market cap and trades at 39x free cash flow, or 32x their 2020 free cash flow. A lot of people would be willing to pay this price because of the high rates of return that Constellation can earn on retained earnings. Interestingly, Mark Leonard's 2017 statement is interesting to explore. Right? He said that I have difficulty forecasting long-term growth in Constellation's intrinsic value per share that exceeds 12% per annum, he said. So there are always uncertainties when it comes to companies. Mark Leonard himself has acknowledged the challenges of forecasting long-term growth in his 2015 letter, mentioning Jack Henry, a vertical market software roll-up focused on banking technologies. So what do you think about Constellation Software? What do you think about Mark Leonard? It's definitely an inspiring story for me, an inspiring person, an inspiring company. Let me know below what do you think. Thank you.